In the ever-evolving landscape of financial markets, the standard models that once seemed reliable have fallen short. The assumption of normality in stock and bond returns, a cornerstone of traditional finance, has been challenged by empirical evidence and the increasing complexity of financial products. Traditional models like the Black-Scholes approach, which assume constant volatility and normally distributed log returns, have been rendered obsolete by the smile effect and fat tails observed in real-world markets. Copulas, revolutionary tools that allow for the modeling of complex dependencies between financial variables, have emerged as a critical alternative. This book, Copula Methods in Finance, by Cherubini, Luciano and Vecchiato, provides a comprehensive exploration of copulas and their applications in financial risk management and derivative pricing. By focusing on the bivariate copula case, the authors highlight the limitations of linear correlation and introduce readers to the more flexible and accurate representation of market cobordments offered by copulas. The first part of the book introduces the reader to the concept of copulas and their role in addressing the non-normality observed in financial markets. The authors explain how the assumption of normality in financial returns, particularly in pricing and risk management, has been increasingly challenged by empirical evidence. The chapter explores the limitations of traditional models like the Black-Scholes approach and introduces the concept of copulas as a powerful tool for handling non-normal distributions. The authors emphasize the importance of copulas in modeling complex dependencies between financial variables, particularly in the context of bivariate relationships in over-the-counter transactions. By focusing on the bivariate copula case, the authors highlight the flaws of linear correlation and provide examples of how copulas can be used to model the joint probability distributions of non-normally distributed variables. The second part delves into the application of copulas in derivatives pricing and interest rate models. The authors explain how copulas can be used to model the joint probability distributions of non-normally distributed variables, making them essential for evaluating complex financial instruments like securitized assets, CDOs, and basket credit derivatives. The chapter covers the state-of-the-art in asset pricing and risk management, introducing the reader to the bivariate copula case, highlighting the flaws of linear correlation, and providing first examples in finance. The authors also explore the statistical inference for copulas, including both methodological aspects and applications from market data, such as the calibration of risk factors and VAR measurement. The text also covers simulation algorithms for a large class of multivariate copulas, enriched with financial examples. The third part focuses on the application of copulas in credit risk applications. The authors explain how copulas can be used to model the joint survival probabilities of multiple default events, crucial for quantifying portfolio credit risk. The chapter discusses the credit contagion phenomenon, evident in financial crises, underscoring the importance of these methods in understanding the interconnectedness of credit risks across different obligors. The authors also cover the pricing and risk monitoring of CDOs, highlighting the importance of simulating correlated survival times to accurately price tranche-specific derivatives. The chapter concludes by emphasizing the importance of copulas in hedging structured finance products, particularly in accounting for counterparty risk and ensuring accurate evaluation and hedging strategies. The fourth part delves into the application of copulas in option pricing and risk management. The authors explore the pricing of complex options, such as rainbow options, barrier options, and exchange options, highlighting the pivotal role of copula duality and the put-call parity in deriving pricing and hedging strategies. The chapter covers the intricacies of multivariate digital options, where the copula function used in put option pricing differs from that in call options, yet maintains a precise relationship that allows for the derivation of arbitrage-free pricing formulas. The chapter also discusses the pricing of specific complex options, such as the option to exchange one asset for another, where the payoff is contingent upon the relative performance of the two assets. The analysis of implied risk-neutral distributions from market option data, particularly using a quadratic interpolation technique, is central to the evaluation of such product. The final part of the book focuses on the estimation and calibration of copulas. The authors explore various methods for estimating copulas, including non-central T-densities for a broader setting, considering asymmetry and kurtosis characteristics. The chapter discusses the use of non-central T-densities for marginal distributions and copula modeling via the IFM estimation technique, estimating frank copula parameters, which shows significant stability between central and non-central student distributions. The authors also introduce alternative estimation methods, such as canonical maximum likelihood (CML), which can estimate copula parameters without specifying the form of marginals. The chapter concludes by highlighting the importance of copulas in financial risk assessment, emphasizing their role in enhancing the accuracy of risk management and portfolio analysis. In conclusion, copulas represent a significant step forward in financial modeling, offering robust tools for addressing the complexities of modern financial market. By providing a more flexible and accurate representation of market movements, copulas enhance the accuracy of pricing and risk management in financial markets. As financial markets continue to evolve,